Thanks for tuning into Talking Point this morning. Well, the conversation has always been over the last 3 months about how strong rural India is looking, particularly with the reforms that are on the agenda as well. But with the stop-start and the lockdowns now sporadically appearing across the Tier 2, Tier 3 and the rural belt, would the recovery look as strong over the next 3 months? Or will rural take a bit of a back seat as well? Let's talk about this and more with Ramesh Iyer. The beauty about talking to him on Talking Point today is that Ramesh just doesn't bring in the experience of what's happening in rural India. He can combine it with what's happening in the financials and the NBFC business as well, simply because he runs a really large rural-focused NBFC. Ramesh, so good having you. Thanks much for taking the time out. Hope all is safe.
Yeah, all safe. How about you?
That's good, Ramesh. Things are so far so good. Hope they stay.
Yes.
Okay, but Ramesh, just starting off from the point that I mentioned, things looked very good until June for rural India. That seems to be just kind of changing at the margin in the last 2 or 3 weeks. What's your sense?
I think what people are missing out, I guess, is in June, the numbers that you saw as improvement had some pent-up demand, right? I mean, things slowed down March 3rd week onwards or 2nd week onwards. And then April, nothing happened. May, nothing happened. So there are some genuine, at least I'm talking of vehicles, tractors, all kinds of products that get bought in that market. So there were people wanting to buy, and they couldn't get an opportunity, let's say, between March to May. So I would imagine that the June number has at least about 25% of that number must have been a pent-up demand. If that was to be adjusted, then you compare June to July, I would think July is doing as good as June is.
Okay, but we constantly hear reports now. I mean, I was talking to R.C. Bhargava a few days back, and he was lamenting the fact that people in India are not realizing the importance of maintaining social distancing and keeping the health, and he was fearing that the numbers might move up, which may make August, September, October not look as good as maybe June, July are. I mean, what's your thought?
Yeah, at least, rural so far was very well insulated from this problem.
Yeah.
Right? So even our branches opened, we saw customers coming to branch, customers going to dealerships. We do hear of some cases here and there. But one advantage of rural is there is some natural social distancing also, right? I mean, rural is so widespread. It's not over concentrated like major cities. There is no mega public transport system in which people transport themselves. Right, and different parts of the day, different activities happen. So I would imagine that while it is moving towards rural to an extent, but the impact of what's happening there may not be as severe as we see in urban cities. Purely because of the nature of activity and the widespread nature of each villages and whatnot. So, but undoubtedly, people will have to be more careful. Especially post September, October, the festival season kicks in and people forget themselves when they start to celebrate and things like that. And some kind of a direction, administrative communication will be very necessary to bring about control. The wedding season will begin, right, post-harvest. So I think all of that one has to be more careful and must have, I would very strongly believe that there has to be a very strong plan that when, post-October as festival comes in, wedding season comes in, what kind of rules and regulations will one have to follow? So you avoid that situation because that's the reality, right? But that period is going to come and people are used to being together and, having their fun and enjoyment and whatnot. So there may be some administrative direction required well in advance to bring about some control.
Yeah, no, I do see that people are a lot more realistic about, slightly relatively smaller festival, Raksha Bandhan, if you will, or what Maharashtra did with regards to the Ganesh Chaturthi decision. I thought they were reasonably okay. But I actually, coming on that too, what's the feedback that you get? There's also this added piece of the reforms that the government is trying to make. I think Ashok Gulati or somebody referred to the current agri reforms as reforms which are as powerful as the ones taken in 1991. What's your thought about the current spate of regulatory changes that are being brought in the APMC thing and otherwise? Because you'll be having a first-hand connect from your teams about what farmers and the rural folk are thinking like.
I think they are feeling very happy about this because these are definitely, good way of institutionalizing otherwise what was happening, right? And given a situation like this, what is everyone looking for? Their produce get bought immediately, they get paid for it immediately, and they get paid directly. And that brings down the overall cost for them as well, and then their cash flows tend to improve. So the sentiments are definitely positive from various actions that have been put in place. And I'm not talking of just the rural initiative of this nature, but even many other things that the government has tried to do, even supporting of MSME. We may not have seen too much of offtake yet from that direction, but definitely they are all good moves. And I am very hopeful that even the further way forward, if you look at mining, coal auctions, road projects. So I think rural will definitely be the turnaround story, with farm cash flows improving and infra cash flows coming in. Put the two together. I think rural will be a space to watch in maybe post-October, maybe post-January.
Okay. So, let's try and then kind of put in together this thought with your business. Now, I was reading a note today, a Credit Suisse note today, Ramesh, and they were saying their belief is that vehicle financing, which has seen vehicle financing NBFCs, which have seen a tremendous growth over the last few years, might go, in their terminology, X growth, which is maybe a flattish number on terms of the growth side for the next 2 or 3 years. I don't know how they are predicting, because a lot of entrepreneurs have told me that they themselves are not able to predict what will happen over the next 1 year. What's your sense? I mean, how is business looking currently? Are you able to predict or think through what could happen to the business over the next 1 year? Because these are such unprecedented times.
I think we have taken a view, let's say, up to March, right? If this March. And if April, May, June was a virtual washout, June was okay, April, May was a virtual washout. And June also by number was better than April, May. But on an overall basis, the number was 40-50% of what was before. So if you were to go that path up to September, and then take a view between October and next March, I would think as we all close March, the overall numbers compared to previous year could be around 50-60% of previous year. That could be the closing numbers. Now, there could be 2-3 reasons for that. It's not necessarily only demand is weak. It's also that the OEMs are not able to possibly make vehicles and tractors available because their own supplies, constraints, and their productions are getting hit and all kinds of stuff. So that's one very clear view that we have up to October. But interestingly, if you take October to March as a period and compare it to last October to March, you may be surprised. It could be flat or growth over previous year. And the reason I'm saying that is because last year, BS6 was kicking in. The festival season was not a big season, right? So all of that put together, last year, 6 months between October, March was not a big number. So if we can hit those numbers in this October to March, right, one would see that it's flattish or slight growth can be registered. If vehicles and tractors could be made available in terms of production meets the requirement, the demand will pick up. Because we're already saying, the dealer inventory levels are at its lowest. So I'm sure the dealers will be wanting to pick up vehicles as the season opens up. And I'm not seeing too much of resistance yet from the market out there. Yes, they may all be asking for maybe a little different types of schemes. Some may ask for 5-year loan, maybe some may ask for a little high quantum or whatever. But asking for vehicle is definitely there. But another interesting feature we saw, at least this 2 months, is absolute genuine buyers are coming to buy vehicle. They are not the ones who say, oh, I've got some 25% margin money. Can I just buy a vehicle and see what can I do with it next, right? So they are actual users of the vehicle or someone who's actually got a business in hand to use the vehicle. So that actually, if you look at what are the kind of products that is asking for, you look at tractors with trailers is having demand. You have pickup vehicles which have got demand. You've got LCVs which have got demand. You've got the small 3-wheeler goods carriers which has got demand. Small cars have got demand. Pre-owned vehicles are being asked. So what is left out from where the demand is still not showing signs of pickup, I would think, is heavy commercial vehicle, right? And the taxi aggregators and taxi operators, tourist operators, right? So they feel their business is under pressure. And these two are not showing great traction. But other than that, I'm seeing other products are showing definite traction and the demand is visible.
Any thoughts on two-wheelers as well? I mean, how is that piece of the puzzle looking?
No, so I think, when we talk of not using public transport, being safe with our own vehicle, etc., I think two-wheeler will be a natural buy for many also. I would not be surprised even if these two-wheeler volumes go up in urban centers. Like if trains don't start in Mumbai for a little longer, or if people start to go to work but do not want to use vehicles and buses. So you may see suddenly a pickup on two-wheeler vehicle and a two-wheeler happening. People willing to travel by a two-wheeler on their own rather than using any other public mode.
Ramesh, the other interesting point, and one of the bankers also made it, and today that other note also making it, that for vehicle financing NBFCs, and I would want your thoughts as to why would somebody think like that, and what is your opinion, of course, that for vehicle financing NBFCs, the dominance in two-wheeler financing will certainly stay, but in PVs and CVs, they might lose more and more market share to banks. Now, what's your response to this? How do you see, or how do you respond to this? Let's put it that way.
I think possibly it comes from the fact that NBFCs normally play a role of expansion of the market. They finance normally the first-time buyer, whereas the large fleet operator or someone who wants a 7-year loan or a 9-year loan or 100% financing mostly have been bank customers, right? So if in this round of volume drop, and if you find these are the types of customers who are asking for vehicle, then obviously it will look like NBFCs have actually lost some market share, right? But as I explained, I'm not seeing that everyone is only in that category. We are seeing definitely genuine buyers wanting to come and buy vehicle. And as I said, yes, people want instead of 3 years, maybe a 4-year loan or a 5-year loan. So any NBFC which has got a wide network or a deeper reach, and they are able to reach customers faster than anyone else, that's one NBFC who could get some benefit of volume. Second, NBFCs who've got enough of funds to be able to participate in the business, because some of the NBFCs, the smaller ones, may still be having difficulty in raising funds, and therefore they may vacate temporarily some space. And therefore, if you look at NBFC number, might come down on that basis. So NBFCs with good capital, adequate funds, will be able to participate, get some volumes. I think the 3 NBFCs which have got large customer base and who have been able to service their customer well and use their customer base as their extended arm, and through them, if they were to get more business from other customers in the same area, I think that's a little more protected business. But clearly, I'm not sure how many NBFCs will want to look at a 7-year or a 9-year loan or 100% LTV. And that could be a business that is good to give up rather than worry to growth and then have such kind of lending, which could eventually hurt at some future.
Okay, so now a couple of facets for your business too, Ramesh. One, any thoughts or any estimates or what have you about how would the asset quality picture shape up over the next 9 months? Is it possible to second guess that?
Yes, it is. The August, the moratorium ends, right? And we will first look at people who have not serviced any loan payment from April to August, right? And then we'll see what are they earning? Are they in a position to repay? And if so, why and why are they not paying? So interestingly, we have seen from 80% of the customers who initially took moratorium, right? More than 40-50% of them have paid installments during this period. Not all of them would have paid all installments, but definitely they have serviced that, right? So we believe they will continue to do so. So the fear is actually out of the other 40%, what percentage of them may not be able to service immediately. So the September in itself could see a little increase in number of people defaulting or not paying. But as I'm repeatedly saying, post-October, if the harvest turns out to be good, which is likely to be after a good monsoon, I think the farm-based cash flows will go up and all the tractor and farm-related cash flow customers will start to repay. So I'm not too worried that will the NPA substantially increase between what it is now to end of March, right? But yes, between August and September, October, before the cash flows begin to happen, you could see some increase happening, but you would see them correct also much, much faster. So, I'm not hugely subscribing to this idea of because of moratorium, the NPA once opens up, we're likely to be too high and all that. Because if they're all earn and pay customer and if their earnings were to start to happen, there's no reason why they would not repay. So which is why, I believe that instead of a moratorium, a restructuring could be a better answer, because one can then look at what customer needs, what kind of restructuring, because some of them are asking for smaller EMI and not necessarily just 90-day moratorium. They say, I can even pay you now, but I can't pay you 12,000, I can pay you 8,000, right? So restructuring could be one answer from the regulator, which can solve this problem to an extent. But on the retail asset earn and pay consumer segment, I am not seeing that the NPA will spurt.
So you reckon for the industry as well, right, Ramesh, the October results season could see a spike up, temporary or otherwise, would depend on each individual company, I reckon. But there could be a sharp spike up, and then the commentaries will determine how good or bad the next couple of quarters on that asset quality picture would look like. Would that be a fair assessment for the space at large?
I think it is, but if you look at the large NBFCs, I think all of us have taken additional provision forecasting that kind of an outcome, right? So everyone has looked at their product segment, they have looked at geography, they looked at application of the vehicle, and then they've taken a view that where and how you need to have additional provision. So that view has already been taken. So even if the NPA by itself had to go up, I think sufficient coverage has been done from a provision, so the net NPA may not spike, right? So the P&L may not see a major impact if additional provisions are already done. And I think I'm hearing most of them say their stance would continue to be to review the situation and if necessary, make higher provisions rather than use the moratorium advantage and not have provisions made. So I think you have to look at it two ways. On an absolute basis, does the NPA go up? My feeling is yes, it could for certain segments for a temporary period. But the second impact is, will all of us be bold enough to make sufficient provision? My answer is a clear yes. We have already done enough, and if necessary, people will do little more and not allow the net NPA to spend.
What about capital raising? I mean, you were in news last week in a big way for the pricing of the rights issue, but that notwithstanding, on both the equity side and otherwise, what kind of capital needs would you have? And would this be a bit of a consistent exercise in the next 12 months, considering the uncertainty that we are facing?
See, most of the time NBFCs have to worry about one side of the balance sheet, right? It used to be for longer, everyone asking about asset quality, growth, etc., etc. And then suddenly things changed after ILFS, and from asset side, it moved towards liability side. I think this is the time where we're talking about the sides, right? We're saying, do you have enough funds to meet all your needs? And is the asset quality holding up for you to feel comfortable? So I think this is the time where the leaders have to look at both sides of balance sheet very, very carefully. My own view is that, you can give up on little growth, but don't move your focus from collections and asset quality for sure, as well as ensuring that you're sufficiently capitalized to meet any requirements, right? So, people have to be absolutely clear about what is their total liability that matures between now to March, what's the interest that they will have to service, and have enough funds made available so that you don't become a defaulter at the liability side. Because for an NBFC, it's extremely important that you meet all your liabilities well on time, because then that has various other impacts like your ability to borrow further when things open up, your credit rating, and all kinds of stuff. So if I have to speak particular for us, I think we've exactly taken that approach. Growth is something that we believe that will happen naturally if the market opens up, product starts to sell, etc., etc. We can only do so much to influence that. So our focus is on collections. Our focus is on to ensure moratorium customers are met, understood, and what is their real challenge. If possible, provide a solution and ensure that your asset quality is well protected. On the other end, we have taken a view and reviewed our cash flow situations up to March, and taking a very, very narrow approach of, the collections could be much lower than normal, and therefore the inflows could be much lower. And therefore, how much funds do you need to store? It does have a margin pressure because, you are at the end of the day storing money, and you're not getting the same return that you pay for. But that's fine. That's a good, way to handle it. Doesn't mind temporarily you incurring some cost, but you'll with sufficient funds to meet all liability. So I can say with all fairness that we have absolutely no problem from a liquidity front to be able to meet all liabilities even up to March, or even discharge interest and meet fixed cost requirement. And the capital raise particularly that we are doing is, not necessarily only to look at it from a fund flow, but also to be adequately capitalized to be ready for future. And who knows, it could go two directions. It could either go a way where COVID becomes a more severe problem, returns in a big way, rural gets hugely impacted, right? And then lockdowns, becomes longer than normal. So you could have a solvency situation reaching if the NPA were to start moving up, etc. So that was the first view that we took in April when the lockdown was announced. So we said we must raise capital. Then when we saw May, June, July, we are seeing volumes pick up, collections improving. We think that it could be a great growth opportunity if things were to open up. So either ways you need capital, right? So therefore we thought the right thing to do is to raise capital, right? So either you don't get stuck with a solvency issue, or you don't get stuck with an opportunity of growth which you are not able to capitalize. So both on the capital front and the debt front, I think we are sufficiently prepared ourselves to meet all future emerging opportunities or challenges.
Okay. And just a follow-up actually to the earlier point, which I forgot, we kind of briefly discussed it. So I'm glad that we're discussing both asset and the liability side, but on the asset quality issues, or if they come up as and when they come up, and I heard you say that they will be temporary in nature. But one fear that the street has is that because there might be these temporary spikes, and what you also said that it's not the best use of money because you can't disburse it, and therefore there will be pressures on the margins. Would you believe that will sustain for the year, and therefore ROEs, margins, profitability, all of them could be under stress for not just the October quarter release, but even the subsequent couple of quarters?
I would think so. Ultimately, all of this will accumulate into lower profits and therefore the pressure on margin. But there are some, initiatives which can help offset this. One is the borrowing cost is coming down, right? So therefore, your net interest margins can hold up because you don't reprice your lending. So there could be an improvement to the net interest margin, which could be one offset that can happen. I think second is, at least we have done, and I'm sure many would have done, we have looked at every line or item of expense and see how do we work around each line item of expense and bring down the cost. Some could be temporary because of the COVID situation, the traveling is less, conveyance is less, right? So those could be one-time savings, but some of them will stay back as to not incur all time like before. But we also looked at many other line items, like whether using a BPO services, looking at our advertising and branding, looking at our branch rent and repricing the rent, all kinds of stuff. So I think we would also start seeing 10-20% of cost saving over previous years arising out of all of this. And no fresh recruitments are happening. They are requesting people to put in maximum effort that they can. So even on the people front, we may not incur a new cost. So if you put all of this together, if you can save about 10-20% cost over previous year, and there is some improvement coming from net interest margin, I'm not saying that is sufficient enough to offset everything else, because the volume drop, revenue drop is not going to be offset by these actions fully. But definite pressure will be there on margins and returns, but to some extent they'll be offset through these actions.
Okay. Ramesh, let's wrap with a positive thing. I mean, something in the last 3 months that has surprised you, or surprised you positively, or made you think that, hey, even this can happen, be it in the normal course of operations of your business, or your chats with some of your lenders who are rural India focused people, what have you, whatever. But in the number of things that have happened, something that has been a big positive beacon of light.
I think two things. One is, we thought people's sentiments will be the biggest challenge to handle when things open up. Right? We thought people would be very worried. They would not want to come back to work very easily. They may not want to go back to the marketplace and interact with customers and all that. I think that took us by surprise. In fact, we were under pressure from the branches to say, when are you opening? Why are we keeping it shut? There is absolutely no problem here. It's a very urban problem. Why are we extending it towards rural, etc., etc.? And therefore, from May mid onwards, when things started opening up, 1,100 branches were open and people are up and working, and they are kind of moving around on the field. So it was a great surprise from what we see here versus what we heard there. I think the second big surprise I thought was, we never thought, forget the business, but we never thought the collections in June would be so high after what we saw in April and May. So our June collections were, against the demand, upward of 77%, in spite of getting moratorium. A large customer base have actually repaid installment. So therefore, the confidence comes that the people are back on some activity normally, people are earning, and people are on wanting to discharge liability. The surprise continued. We thought that it could be one of June and whatever. July continues to maintain that kind of a collection efficiency as we speak. So I think collections from customers who on their own want to come and pay, people are using digital means to pay and all of that. But more importantly, their intentions to pay is being held very high. So that's a great surprise. I thought that in an unforeseen situation like this and an unknown tomorrow, even if I had the money, people would say, let me keep it and see how things pan out. But no, they wanted to discharge liability, which is a great news. And the last would be, I think we never thought the business will come back to some normalcy. In spite of vehicles, tractors, etc. not being available, we did 30,000 vehicles in the month of June. So if vehicles were to be available sufficiently, we could have done maybe around 42,000 vehicles, which would have been 80% of the previous volumes. As I said right at the beginning, knock it off for the pent-up demand. But nevertheless, we never thought in a situation like this, so many people will come forward and wanting to acquire vehicles. So both on the business front and people front, I at least did not believe in May that things would open up so well and it will be so positive. So it's been a great positive news for us.
Well, hopefully it improves even more. But great talking to you, Ramesh. Thank you so much for speaking to us today and giving us your thoughts on the business and on the space at large.
Thank you. Enjoy talking.
Always. Thank you so much. Stay safe.
Thank you. You too. Take care.
Thank you. Thank you. And viewers, thanks for tuning into this edition of The Talk.